Hello, everyone. My name is Jeffrey Kennedy, and welcome back to another episode of Market Academy. And welcome to this is going to be week 4 of our little series, our basic review of the Elliott Wave principle. And this week we're going to be discussing the flat correction. Now, the flat correction would be this pattern right here. Now, you might recall last week, whenever we were talking about the zigzag, I referred to a notation called 535. That's a notation or kind of abbreviation that Elliottians sometimes use to identify a zigzag because wave A subdivides into 5 waves, wave B subdivides into 3 waves, and wave C subdivides into 5 waves. Well, the notation we use to identify a flat correction is 3, 3, 5, meaning wave A subdivides into 3 waves, wave B subdivides into 3 waves, and then of course wave C will unfold in 5 waves. And if you go back and listen to the lessons we did on impulse waves and diagonals, we know that wave C of the flat correction can unfold in an impulsive manner, i.e. 5 waves, or take the shape of an ending diagonal. So let's move on and take a look at a few examples here. This is essentially what a flat correction is. And again, 335, notice the notation in the upper left-hand corner. But also, too, it's important to remember one of the defining characteristics of a flat correction is that wave B ends at or near the origin of wave A. So whenever you are working a flat correction, you're looking for that wave B to kind of go back up and test the neighborhood of where the wave A sell-off actually began. And this can sometimes give you that what old school technicians might refer to as a double top. Okay. Now, in this example here, let me go back to this example. Well, no, I actually have an example. I want to talk about slope analysis, but just in a minute. I'm getting ahead of myself. Okay, now, as far as the relationships we see within a flat correction, very simple, very basic, basically equality. Okay, we're looking for wave B to equal the length of wave A, and we're looking for wave C to equal the length of wave A as well. Now, you might remember going back to last week's lesson, we looked at very specific Fibonacci relationships that you tend to encounter within a zigzag. For example, the most common Fibonacci retracement for wave B of a zigzag, does anybody remember this? Well, that would be 0.382 followed by 0.618 followed by 50% retracement. And then some of the multiples we see between wave C and wave A, of course, would be equality followed by 1.618, then followed by 0.618. Well, what you see here, again, with a flat, very simple, basically what we're looking for is equality. Now, you also, too, might remember going back to last week, I kind of spent some time on this, and I was talking about slope analysis. What kind of personality do you see within the actual unfolding of a zigzag correction? And you might remember that whenever we were discussing the slope of, say, wave C versus wave A, I explained that within a zigzag, what we tend to see more often than not always, but more often than not, is that the decline, the sell-off, the move in wave C will be less aggressive than what occurred in wave A. When it comes to a flat correction, which is what you see here, just the opposite occurs. Actually, wave C is going to be more aggressive than what you see in wave A. So you would see a 3-wave decline in wave A, kind of slow, 3-wave move up in wave B, kind of slow, and then a kind of a pop down, impulsive drop down. Now, going back to, again, one of the defining characteristics of a flat correction, on that wave B, again, we're looking for wave A to end at or near that origin point here. Okay, now, the way I kind of look at it is the sweet spot for the termination of wave B, of course, is going to be, again, right pretty much at, or like maybe a couple of pennies above, but pretty much at the origin point of wave A. But at minimum, I'm looking for an 80% retracement in wave A. Now, if you have a copy of the Elliott Wave Principle book written by A.J. Frost and Robert Prechter, I know one of the guidelines that Robert talks about, Mr. Prechter talks about in his book, is that he requires at least a 90% retracement. Well, with all my time looking at commodities, the grain markets, a lot of futures markets and currency markets, over the years I've kind of learned to adopt a little bit more, say, less stringent guideline. So for me, at least I want to see in wave B, as far as retracement of wave A, 80%. So you may want to write that down, 80%. So in other words, wave B must retrace at least 80% of wave A to be a wave B, because if you have a three-wave decline in wave A and then a three-wave rally in what you think is going to be wave B of a flat, but you stop at the 60% retracement instead of the 80% retracement, then the more appropriate interpretation would be WXY, or a complex correction, or what I like to call an extended correction. Okay, now let's move on. And again, some of you know about my Kennedy channeling technique. Again, all it is, it's actually a very basic, very simple trend line algorithm I use to differentiate counter trend price moves, corrective wave patterns, with trending price moves. And the big, say, cornerstone principle of the Kennedy channeling technique is that counter trend price action tends to be contained by parallel lines. Now, whenever you're working a zigzag, as you well know, drawing that corrective price channel is actually quite simple, quite easy to do. But there sometimes is a question on how you actually draw the corrective price channel whenever you're working a flat correction. Okay, so what I've observed over the years is I start again at the origin point of wave A, and then what I've learned is I either use the extreme of wave 2 as my pivot point or the extreme of wave 4 as my pivot point. Okay, so if we use the extreme of wave 2, then the floor, the bottom that I'm looking for wave C to fall to, would be, of course, the lower boundary line of the corrective price channel. Now, if we use the extreme of wave 4, then we might actually see, say, a center line reversal. Remember we talked about center line reversals in the explanation of the corrective price channel whenever we were discussing zigzags? Well, this is how I draw the corrective price channel, again, whenever you're working a flat. And this guideline here also, too, works very well if you're working an expanded flat. Now, an expanded flat we'll look at next is simply a variation of the original regular flat correction. So kind of a rule of thumb I use is that if we're working a flat correction, then I use the extreme of wave 2 of C to draw the corrective price channel. If we're working an expanded flat, then I use the extreme of wave 4 of C to draw the corrective price channel. So now let's move on and take a look at what occurs whenever you see wave B exceed the origin point of wave A. Well, this is referred to as an expanded flat, and what you see here are sometimes the most common, say, Fibonacci multiples between wave B and wave A of the expanded flat. Now, just me personally, again, we're doing this for over 30 years now, I really like that 1.382 multiple between wave B and wave A. So if I see a three-wave decline in wave A and a three-wave rally in wave B, and I'm kind of thinking flat correction or an expanded flat correction, then I'm looking for that 1.382 multiple. And then, of course, following that, we see the wave C decline. These are going to be the two multiples that we see there. Either wave C will equal a 1.618 multiple of wave A or a 2.618 multiple of wave A. But this is, again, what an expanded flat looks like. And all an expanded flat is that wave B terminates beyond the wave A origin point. And also, too, the subdivisions don't change. It's still 3, 3, 5. 3 down in A, 3 up in B, followed by a 5-wave decline in wave C. So the expanded flat is actually a variation of the core pattern, and the core pattern, the regular flat, is this structure, this formation. Well, there's actually a variation to the expanded flat, and that kind of incorporates a characteristic that we refer to as a truncation, and that would be the running flat. Okay, now a running flat occurs when wave C is unable to terminate below the wave A extreme. Now remember, whenever we were doing our lesson on impulse waves, I talked about one of the characteristics that can sometimes occur, or one of the complexities that can sometimes occur within impulse wave development, and that is wave 5 not moving beyond the wave 3 extreme. The result is a failure or a truncation. They're very significant events to watch out for. They're very rare events to watch out for. But when they do occur, they basically are giving you a heads up that there's hidden or underlying buying and or selling pressure. So for example here, wave C, now for a running flat, wave C, I really want that wave C to terminate below the 50% point of the wave A decline. Okay, this is what I'm kind of essentially looking at as far as a template of a proper running flat correction. And remember, whenever this occurs, that subsequent move should indeed be quite volatile. Running flats are, again, kind of a rare pattern, less than 20% of the time. But whenever they do occur, pay very, very close attention to it, because the subsequent move should be somewhat volatile, because that underlying buying pressure is coming into the market, thereby preventing that wave C to terminate where it actually should, which would be below the wave A extreme. Now, one more variation or complexity, of course, we looked at this whenever we were looking at zigzags, and that would be the double zigzag. What you see here, this is a double 3, where you have a flat correction in the W position, and then another flat correction in the wave Y position. Now, complex corrections or combinations, those occur whenever these are mixed. You have zigzag and then a flat, or a flat and then a zigzag. So a double zigzag is simply an extended correction where you have two zigzags joined together by an X wave. A double 3 is an extended correction where you have two flat corrections joined together by an X wave. A combination is an extended correction where you have either zigzag X wave flat or flat X wave zigzag. Okay, everyone. Well, that about does it for me for today. Tomorrow we'll begin to, again, evolve with our knowledge, take it the next step, and look at flat corrections in real markets. Okay, everyone. Thank you as always.